Hi, my name is Eduardo Bogosian. I'm the CEO and founder of Maestri Investment Group. Today we're going to be taking a look at our budget control Excel sheet. We made it a while back and we've been updating it ever since, and it has been a major success, surprisingly, much bigger than we thought it was going to be. So we're very happy that this Excel sheet that we've created for previous investors and people who were having issues budgeting their money, we're glad that it has been helping people. So today we're going to take a look at it and we're going to talk about how to use it in a pretty simple manner. Okay? So first off, let me clear all of this. Okay, don't worry, we'll be starting from 0 here, okay? All right, so this is what your Excel sheet should look like once you get started. What you have to do is delete everything that's here and everything that is here, okay? These two sections, the in and the out sections. First, we're going to start off with our wages. Now, let's say you are a person that works with sales, and let's say you have $1,000 a month salary. All right, don't worry about changing colors and stuff. This is all done automatically. So what we have here is we have your wage. We're going to put that in first, and here we are, $1,000 every month per month. Now let's say that you also get a commission. We can change interest here to commission. And this is going to vary, right? So one month, let's say you get $100 commission, another month you get 50. This one you didn't do anything, wasn't good. Let's say 75. And we're just going to throw in some random numbers to give you an idea. They really don't matter. These are just random numbers I'm putting in just to kind of create a scenario so you can see what we're talking about, okay? So what we're doing here is we're going to start with everything that's more stable, and then as we make our way down, the things that are less stable, right? So wages, you get your wage every month. That's good. That's a stable income that you have. Now let's say commissions. Commissions vary from month to month, so that's going to be the second thing you put in. Let's say there is even a third income source that's even more variable from month to month. That would be down here as well, right? So that month, this month, let's say you just made some extra money. We're just going to put it in there just to give you this idea, right? So what you would do is you would put in the base, so your wage, and then as the months go by, you add, whatever commission you made, whatever extra money, you can classify them. This is just so you get started. This is what you have to work with, right? So we're going to delete that. We don't know what's going to happen in the future. All we know is that we get the salary, your wage every month, $1,000. Bam, that's it. Okay. Now, the first thing you want to do is you want to get rid of anything that costs you money, right? So the way we like to think about how to spend our money is we start with things that cost you money, right? Then the things that are going to get you money, and then lastly, the things that are just for fun. So the first thing, for example, we're going to be talking about bills, especially things with interest, such as loans. That's the first thing we put in here. So if you're in debt, this is one way that might help you, okay? Now, this is not financial advice. This is just a sample Excel sheet that you can use to help you get started. For some people, it has been enough. For some people, it has not been enough. The important thing is that we start, okay? And this is a pretty good way to start. It was the best that we've figured out, and we're always updating it. So let's start out with a loan. Now, since loans they have interest, they're the things that are going to be costing you more, okay? So let's say you've got two loans, okay? We're going to call them loan 1 and loan 2. What you want to do is you want to first make sure you're paying off the loans with a higher interest rate, okay? So let's call loan 1 at $15 a month. Now this is an important part. When you put in the in section, you want to put it in as a positive number, right? Plus 1,000, plus 1,000, plus 200, for example, right? So the money that goes in is a positive, money that goes out is a negative. See, make sure that it is in red, right? So we've got $1,000 coming in, and right now we've got $15 going out. That's $985, okay? So we know that's correct. So make sure that everything that is in here that you type in, this has to be a negative number, all right? Okay, so let's say that we've got two loans. One of them is a higher interest rate at $15, and second one is a slightly lower interest rate at $20. Now, it's better to pay off your higher interest loans first, okay? So we're going to put that as our first thing to pay off every month. We're going to start out with that. And the second one, which isn't as bad, but it's still a loan, that's going to be the second thing we're going to pay, okay? Now, before we get into investments, which the first thing you should get out of your way is loans, because you can't change, generally speaking, you can't really change how much you're going to pay on a loan. It's a predetermined value. This is not going to change. So, this is something that you have to deal with more than it's something you can mess around with. You can think about renegotiating, you can talk about changing your fees, you can pay off it early, but generally speaking, it is pretty stable month to month payment or week to week, whatever you have set up, okay? So that's the first thing we're going to put in there. Why? Because let's say your electric bill. You can change your electric bill. It's not easy, but you can turn off the lights earlier. Lights aren't even that big of a electricity use nowadays, but computers, you can, if you're out of the house, turn them off. You can reduce your water bill by showering. You turn off your shower while you're get yourself wet, then turn off the shower, put on the soap, whatever you use to clean yourself, and then turn the water back on. That will save water. That will save your water bill. That's why bills are here under expenses and not here on above investments or loans, right? Now, a good thing to have is some sort of safety net, right? People usually say 3 to 6 months of monthly costs, or 3 to 6 months of whatever you earn. But whichever of these two you prefer, or if you want to leave more money set aside, 2 years would be the maximum I would put in personally. But 3 to 6 months of monthly expenses, that's already a good start. So first things first, we're gonna pay off whatever loans we have. Second of all, we're gonna start up. We're gonna start saving some money. Okay, we're gonna start setting some money aside. Let's see. Actually, let's do it like this. Okay, we got all the months are the same, so I'll just say we're gonna put in $5 every month, and as you can see on the top right corner, as we fill this in, you do get the savings account over here going up. If these numbers don't match, don't worry. As interest comes in, you can put it in here under adjust, or here we can set up interest, and as the months go by, you can add whatever interest you have. Okay? All right, so the first thing is loans, so that which is worst. Then we're going to talk about saving. Now, this is not a recommendation, as I said. This is not advice. This is not financial advice. We put in here our two PAM accounts, the IPF and the IPFX2. Now, let's say we want to invest in that as well. Let's do the same thing we did here, right? Let's put $5 in each every month, just so we've got a nice and steady portfolio that we're dividing up and investing in a wide range here of instruments. We've got a savings account. Now we've got some PAM accounts. You can also do some CDs, bank CDs. You can also do that. So creating a diversified portfolio is really what you're going to be looking at, okay? I don't want to make things too complicated, so I'm just going to leave things like this for now. So now let's talk about monthly bills. One thing you can do is get the average. Let's say your average is $60 a month on electricity and let's say $30 on your water bill. What you're going to do is you're going to get this average and you're going to project it forward. So even though this amount is going to change from month to month, for example, this month you might have spent more, so negative, minus $35. This month we had some sort of party, so a lot of friends came over, really exaggerated on the electricity. So you update these as the months go by. Now, the reason why we put this in beforehand, we put this average, is so we can look at this chart and see what is your money doing. How is your checking account doing? How are your savings doing? So this way you can project ahead and have an idea of where you should be, right? Maybe there was some sort of emergency and you had to pay, a lot of money. Are you going to be able to cover it? Well, if you do this, then you'll have a better idea if you can or not. Okay, so now that we got the average electrical bill, we're gonna work as if we're at the beginning of the year. Okay, so everything's the same. $60 for electricity bill. This is all the same. Water bill, $30. Same. Okay. So now let's talk about subscriptions. Let's say you have some sort of magazine, some sort of newspaper, game, anything that you've got a monthly subscription, they're going to go in here, okay? And one thing you want to do is you want to go like this. Let's say you've got a newspaper subscription, okay? Newspaper subscription, okay? I'm just going to double click this so it fits. Okay, so you've got a newspaper. You pay every month, let's say $5 for your newspaper, okay? So this is a subscription. It's every month. It's $5. You don't have to worry about it too much. But let's say you have another subscription that is for a magazine. Let's put in magazine subscription. And to save money, you decide to go with the yearly plan. So once a year, let's say in April, you pay $50, right? For the yearly plan. Now, what you want to do is when you've got subscriptions like this, subscription 3, and name this one 4, right? What you want to do is you want them to be in order. So the first one on this list here, first one on the list here is going to be the first one that you pay in the year, right? So let's say the second subscription, it's for let's see, what would be a good subscription? Let's say coffee, right? Also an annual subscription. If you pay it in February, for example, you would want to put coffee first and then magazine second. Why? Because it's going to be a sequence that goes from left to right, which is going to make it much easier for you to have an idea on what is going on with your money. So if this is the first one and this is the second one, you know that the second one's going to be further ahead. It could be, the next month. It could be even the same month. You just don't want to do this. You just don't want to have the one below it be paid before the one above it, right? You want them to be in sequence. So magazine, subscription, paid a year, paid yearly, and a third subscription, let's say you paid it in November. Maybe you want to get something nice on Christmas. So you want to follow this general rule, okay? Awesome. Now we've got our fixed expenses, right? These we know every month or every year, right? Following the sequence here, you're going to have to pay. But what about the ones that vary? So that's what we're doing. We're starting with what is most constant. So that's why we started out with the electricity bill. You're going to pay that every month. Doesn't matter. Water bill, right? Same thing. You pay it. You could have an internet bill as well. That's another thing we could add here. And you've got a couple of subscriptions here, you know. Let me delete this one. Okay, now we've got a couple of subscriptions here. The one for coffee, one for magazine. Oops. There you go. This one's subscription. And this way, you know what your fixed payments or bills are ahead of time. Now let's talk about things that vary. For example, let's say you want to go to a restaurant, right? So let's say you go out, you go to the restaurant only, once or twice this month. This month you don't go out at all. You can even leave it blank. It helps make things a little bit neater looking. This other month you spent 25, then you went crazy. You're like, oh yeah, this has been an awesome month. It's end of the month. It's June. I'm going to be taking some time off in July, so we'll put that there. Anyway, so these that vary and we don't really know, we start putting them in at the end, right? So we've got restaurants. These are more of common bills. So eating out, groceries, for example. Groceries would actually be above restaurant, right? Because groceries you buy on a more fixed basis than you go to a restaurant. You buy groceries every month. So here you could put in, how much did I spend? Oh, $50 this month. I spent $40 this other month, so $30 this one. Remember, always use negative. Minus 80. Now you see that we're creating here a variable expense that is in front of the magazine subscriptions that are yearly, right? That's because these are fixed, right? So these are fixed or mostly fixed, and these vary, or they vary more than these vary. So what you want to be looking at is this. Sure, you can turn off your computer, you can save during the shower while you're brushing your teeth and all that, but there's going to be a limit. Groceries, you might want to spend a little bit more, a little bit less, but these you can't really cut off too much. Eventually there's going to be a point where this is the minimum electricity that I can use, this is the minimum water I can use, so there's less room for improvement here than there is here. Now groceries, we were $50. That's, that depending on where you're from, that's a really good number. And then here minus 80, that's a very much higher number than the other ones here. So maybe you bought a lot of soda, you bought a lot of snacks. These things are expensive and you eat them up really fast. So even though there are things you can do about it, you can also just choose not to buy it, or you can choose to ration it, eat more or less of these. Some are more expensive than others. Sometimes you want to get something that's special. So these you have more control over. There are basic things, but on the higher side, on the upper side of how much you can spend is much higher than you would usually do with electricity bills. So that's why we've got our subscriptions here, which should follow this order. The first one is the first one to get paid, the second one is the second one to get paid, and so forth. But groceries, restaurant bills, anything that's going to vary, you can even maybe put in a bar if you're the type of person who likes to go to bars and drink, maybe, hang out with friends after work. um, these are going to vary, and you can control them much easier than you can the first bills, okay? So it's the same idea. You're going to put in, you can, grocery is something you have to purchase every month, so let's put in an average of how much we spend and just project it forward. This way we have an idea, okay, so I've got my groceries, this is more or less what I spend, and then whatever month you spend it, you update it to whatever you actually spent in that month. Same thing for restaurant, bar, and the credit card bill. This is something you want to make sure you're paying in full, and you can put it in here. I'm just going, whoa. Put it in here, and this is going to be just some random numbers, just so we see how the year is going. Oopsie daisy, there we go. Saved up. Always paying in full. And now we're starting to have a really nice looking budget control sheet, right? We've got our loans. Let's say we even finish paying off this loan early. So we know we're going to have to pay the loans. So we've got them here. We've got your investments. So you're creating a safety net for you, for your family. Another thing we could add here would be, for example, health insurance. I mean, all kinds of things that you pay on a monthly basis, okay? And then we're talking about subscriptions. We put them in order. So the first one on the list is the first one to get paid in the year. Second one's the second, and so forth. Then we've got groceries, which vary, but every month we're going to be buying groceries. And then we've got like restaurant bills, we've got bar bills, things that are going to vary a lot from month to month. And these are just the most recurrent ones, okay? Now, the last thing in the out section is the adjust. Now, I'm going to read this out here for you. Sometimes you may end up forgetting to add or remove something. Use this field to adjust the difference between the value of the spreadsheet and the value that actually shows up in your bank account. The less you need to use it, the better. So, generally speaking, let's say here at the end of the month, it says you should have $775, but what is actually in your account is $750. So you decrease $20 here, or maybe this month it says you would have $1,520, but you saved money somewhere else, so that's a positive. So you add $40, and you always make sure that this final amount here matches what is in your bank account, okay? Now that we have this sorted, we can see how our savings are doing over the year. So January, we made our first deposit of $5, right? At the end of the year, we now have $60 by depositing $5 every month. So here we can see how it's going to grow. And here we've got our checking account, which by the size of it, what we could do is we could probably increase our savings, right? So maybe you just got started, maybe you had some money from beforehand. So as time goes by, you start getting a better cushion here. You can put it in your savings to reach those 3 to 6 months of expenses first. Over here, you can sometimes work with it a little bit lower than what it is now. It's really going to vary from case to case and from person to person. It's going to be what makes you feel the most comfortable. So, I mean, it is pretty simple, okay? Let's just go over this and let's talk about what we did. The first things first is what money comes in. So here we make $1,000 a month. That's our base salary. And we added here that we get a sales commission. We can add these as the months go along. Oops, that's positive 50. And we're always putting in positive values for what money comes in. Here we've got the net, and we can see which are the best months and which are the worst months. So for example here, February, which is the darkest green, is the one that you made the most money. So if you're going to have a big expense, this is a pretty good month to be looking at. On the other hand, April here is our worst. So if you're going to have a big expense, April's probably not the best time to do it. Now, all of this is automatically calculated. Don't worry about it. You just have to type in the numbers. Okay, now we're going to follow the same logic that we did with the in. We're going to do with the out. So the money that comes out, we're going to start paying off our higher interest loans first. So we're going to even type in higher interest and lower interest. Now, the sooner we get this paid off, the better. This one will be our second priority. And we want to make sure that we're paying everything on time. And these numbers, since it's money going out, it's a negative. Money coming in is a positive. Now that we've taken care of loans, which are, the first thing you want to get rid of, now we can start saving money because we want to have money set aside for emergencies. We want to have money set aside for big purchases, accidents, anything that can happen. You want to be able to afford that and not have to use up your money in, say, April, which in this case is a bad month, and then ending up adding another loan. You don't want to do that. It's going to cost you money. It's better to have something yielding something and then just use it in an emergency than having to resort to loans. So we've got our savings. After we got our savings set aside, we can talk about some more diversification. In this example, I used Maestre's PAM accounts. That's just an example, not a recommendation. You could put in CDs, all kinds of stuff here, okay? Awesome. So we got rid of what's costing us money. We're then creating protection for our money. And now we're going to talk about our bills. So we got our latest electricity bills, our latest water bills, and we just kind of averaged it out. We take a look at it, see how much we're spending in every month on average, and we're just going to put this for every month till the end of the year. And so it projects forwards what we expect to happen. Of course, as the months go by, you can adjust these numbers. Always as a negative, money going out, negative. This month we spent more on this one, more on this one. This is a really bad month. However, here we were able to save. So you update these as the months go by. Then we've got our subscriptions. The ones that are paid first come first, and the ones that are paid second come second. The ones that get paid third come third. And you create this sort of a ladder so you know when to expect these payments, and it just makes it look neater overall. Okay? Now again, always as a negative, groceries. What are we paying groceries? We can take a look at our latest bills, see how much we spent in the past few months, and create an average. We can put in, let's say 50. Let's say you spend $50 a month. Now these are just numbers that I'm putting in just to represent. These are not proper percentages or recommended percentages. These are just random numbers I'm throwing in just so you learn how to take a look at these, okay? Then we've got restaurant bills, and these really vary from month to month. So let's say this month we spent $12 going out. Now it's been another month. It's February now. Let's say we spent $90. We were really happy that month. March, we weren't really interested. Maybe we went out once, and so forth. And then you go adding these in as they show up. Maybe you spent a long time not going. Maybe you had classes. Maybe work was really hard. Maybe you were working on a project, and you just didn't have the time. So there can be gaps like this. Don't worry about it, okay? That's why we put these fixed bills, or the ones that vary the least, first, so then we can have these and still have it looking nice. And then we've got our credit card bills. We want to be making sure we're paying them in full. This month, let's say it was 50, another month goes by, minus 55, and so forth until the end of the year. And at the end of the month, we want to make sure that what is shown here in the Excel spreadsheet is the same as what our bank says. So we're going to use the adjust to add with a positive number, right? So we can add or remove negative to make sure that this number here, right here, okay, every month, matches what it says on our bank account. Now, there are some things that, for example, let's say you bought a present. Now, you're not going to be buying a present every month. So there's no need for you to add, oh, presents, and just have like one instance where you bought a gift, right? This doesn't make sense because it's just going to clutter up your budget. You don't want to have this here. You can maybe, even if you didn't buy it if you didn't buy it in your credit card, then you can just put it in under the adjust. If you did pay with your credit card, then it's going to come out in your credit card bill. If you pay it in cash or you use debit, anything like that, you can just adjust it using the adjust function at the end. The important thing is to keep this as clear and as understandable as possible for you. Okay, you are a unique person. You've got your own way of doing things. The important thing is that the Excel sheet here makes sense to you, that you can look at it and you can say, okay, so October is looking like a good month, like it's going to be a good month considering how I'm spending, and this helps you make decisions. Okay, so $50 a month, is that a lot? Is that a little? How are these numbers going and how are they affecting my life? How can I adjust them? What works best for me? And the answer is that there is no one answer, right? We all have our own individual lifestyles. We all have our own situations that we're in. So there's not going to be something that fits everyone, okay? So don't worry about it. The important thing is that you are comfortable, that you are able to make better decisions, and that you can keep control of your money so that you do not have to resort to loans to keep yourself afloat. If you have got dependents, you've got children, or maybe you take care of your parents, all that kind of stuff, you don't want that to hurt you or them. So this is something that you're going to be updating as the months go by, as the years go by, and you're going to end up with something that looks good to you, that works with your lifestyle, and you're going to be looking at it and you're going to say, look, I got to cut these bills down. Maybe I don't need the subscription, this coffee subscription. Maybe I can get rid of that. And this is totally and completely unique to you. Now, if you do want a few tips, we do have some general rule of thumb numbers here that you can take a look at that will help you decide if you're spending too much or if you're living within your means. I'm just going to paste this real quick just so we can take a look at housing costs. Generally speaking, your housing costs should not exceed 25 to 30% of your income. Now, what are housing costs? Everything that's related to your house. So let's say your rent, if you're renting, your mortgage, if you're paying a mortgage, water bills, electricity bills, internet bills. These are your housing costs, and you don't want them to exceed 25 to 30% of your income. So let's take a look. We've got the electricity bill and the water bill. Let's say no rent, no mortgage. You've got a fully paid house. Maybe you live with parents. Maybe you live with friends, and this is your share, right? We've got here a total of $90 that we're spending, right? So 90, and we're making 1,000. So if we get this $90 a month and divide it by our 1,000, if you're keen on math, you already see that that's about 9%. So we'll just multiply that by 100, and we've got here 9%. So 9 is way below 25 to 30%. So you're comfortable there. That's a good margin. Now let's say you were paying also we'll change this to rent, okay? And let's say this is $500. Now at $500, if you're making $1,000 a month, then that's not looking good. Let's take a look. So we've got 90, so we've got 60 for electric bill, 30 for water bill, and 500 for your rent. You're paying $590, right? $590 out of your $1,000 you make a month. That's almost 60%. That's 15, almost 60% of what you make is going to housing costs. So that is too much. That's living beyond your means. Unfortunately, this is something you can't always control, but be aware that this is something that's costing you money. It's not generally recommended, and you might want to look into this, okay? Now, one thing we didn't add in our portfolio, but we can, is your retirement. So you want to be saving between 10 and 15% of your income. You know, they always say the more the better. 10 to 15% is just a nice number to get started. So 10 to 15% of what you make a month, you save towards retirement. So if we add these two, right, you got 30, that's housing costs, plus 15, that's 45%. So ideally, we're looking at 55% of your money being free for you to be able to spend on things that you want to spend, whether it be a coffee subscription, whether it be going out to restaurants. This is basically ideally kind of like what you have left over. We're not counting grocery bills, so this is just a rough estimate, okay? This is just to give you the ballpark that you should be in. This is the stuff that they should teach you in school, but they do not. So we can put this to, for example, 50. Let's set it to 50. Your rent, let's see. You're just really helping out. Really depends on where you're from. We have people from all over, literally all over the world. So we don't want to single anyone out. So 140, that's 14%. I already know that, but let's just do the math to make sure. So we've got the 140 divided by your 1,000. And if we turn it into a percentage, it turns into 14%. That's well within the 25 to 30% that we see here as being recommended maximum. So 15%, that's a pretty good number. You're living within your means, and you're not overexerting yourself. If you can, more, as I said, but you don't want to do too much either. I can't see I don't know of any cases where people would need to have over 2 years of money saved up. So I think that's really really high upper bound. 9 to 12 months if you really want to be sure, but 3 to 6 months of spending, you can turn this into 3 to 6 months of salary saved up in a savings account or something that's very liquid like that, where you can easily retrieve it if you need it. And this will be your emergency reserve. Now guys, I hope this has helped you in working with our spreadsheet. I will leave a link to our blog post where we talk about it. We show these numbers. This has really been a video rundown, so you can follow step by step what we do to create this Excel budget, how to keep track of it, and how we can help you look into the future and make better financial decisions. Thank you so much. Be sure to leave a like and to subscribe. Make sure we can keep the channel growing, create even better content as time goes by. Thank you so much, and see you guys next time.